We are in the bear market, and we're in the perfect storm right now with high inflation, the Fed's raising interest rates, the housing market slowing down, and the Wall Street selling off stocks. Our growth stock portfolio, and I'm not even kidding, is down exactly 50%. And that's the portfolio we own stocks like Tesla, Facebook, DocuSign, and Tattoo Chef. Don't even get me started on Smile Direct Club because it's down 78% since I purchased it last year. And it hurts to see my portfolio like that, and all I can do is just stay calm and take a sip of bourbon. My dividend stock portfolio, on the other hand, because we invest mostly in defensive and cyclical stocks that pay dividends, this portfolio is only down 10% year to date. And I said only 10% because it's better than 50%. And I know that as stock prices go lower, their dividend yields go higher. And I strongly encourage you to check out my video about our dividend stock portfolio, and I will put that link in the description below. I also bought $33,000 in one stock and an index fund, and if you wait until the end of this video, I'll show you what I purchased. And for God's sake, this is not financial advice, and please don't buy anything just because I bought it. Pinky promised me that you'll do your own research before you buy anything. Pinky promise. And I want you to write these dates down. The Federal Reserve is looking to meet again on June 15th or 16th, so I would pay attention to how the stock market reacts. And that depends on whether they will raise 50 basis points or maybe even 75 basis points. This is also 5 days after the Labor Department releases their latest inflation data on June 10th for the May CPI data. And if the inflation rate falls slower than expected, then the stock market may not react well to that news. We'll see what happens, right? But for those of you on the FIRE journey, should you delay your retirement or invest differently? If you're close to your retirement, should you delay your retirement? So if you're looking to retire early in 2022, this market might not be giving you any confidence to retire just with your stock market portfolio, right? I completely understand, because if I were in your shoes, I would probably hesitate to retire until I see better news in the overall stock market. And there's nothing wrong if you choose to stay employed for another year, because this is a great opportunity for many FIRE people to want to buy the dip. And let me tell you what we would do if we had to retire in 2022. First, I would make sure we have enough cash to last the bear market. And the average bear market could be anywhere between 12 and 18 months. The S&P 500 in 2008 went down almost 40% that year, and the market didn't bottom until 2009. We're not even halfway through 2022, and the S&P 500 is down almost 18 or 19%, right? We would have 2 years of expenses saved in our emergency fund, so we don't have to sell stocks, ETFs, or mutual funds at a loss. Second, we would use other income sources like dividend income, real estate, or pension to help pay for our expenses. If we were eligible to withdraw from our pension funds, then we would budget around our pensions. My wife and I are probably going to make anywhere between $50,000 and $60,000 a year just from our pensions, which will cover our retirement expenses, if not more. We would also have at least $40,000 a year in dividend income from our dividend stock portfolio. We should also have rental income to help pay for our expenses as well. Keep in mind, the goal here is to not withdraw anything when we're experiencing a bear market or a lot of uncertainty in the economy. Third, we would probably adjust our withdrawal rate from 4% to maybe 3% for the short term. And for example, if we had $2 million invested in the stock market with a 4% withdrawal rate, that's about $80,000 a year in passive income, right? With a 3% withdrawal rate, that's about $60,000 a year. And this would allow our portfolio to grow more with the extra 1% we left behind in our portfolio. This is not financial advice, just one of the retirement strategies we have in place in the case of a bear market. Well, it's spelled bear or bear. You know what? I have Grammarly to check my spelling. Grammarly can proofread your writing and save you so much time and make your writing look professional. I've been using Grammarly Premium since 2018, and it saves me so much time from having to proofread my emails. I also use Grammarly to proofread my resume, which got me a job paying 6 figures in salary. You can get the free version of Grammarly, and I will put my affiliate link in the description below. Whenever we experience a market downturn like we're seeing right now, it's really hard for people to see what the market will do in the long term. And you can always use the bucket strategy to have a short-term cash reserve like the emergency fund worth 2 years of expenses I just talked about. You can also create another bucket for medium-term withdrawal, and that's something that you need money to last during your early retirement. Since we're retiring at 45, we'll have a separate bucket to make sure our money lasts from age 45 until age 59.5, which is our normal retirement age. We're also going to have a long-term bucket strategy, which is something we'll withdraw starting at age 59.5 and beyond. And these accounts will be our Roth accounts, like our Roth IRAs or HSAs, because we won't have to pay any taxes on the earnings. Another question I want to answer is whether you should delay your early retirement, and it's going to depend entirely on your overall expenses. And I always encourage my audience or tell my clients to divide their expenses into two categories: discretionary and essential expenses. So for example, my wife and I will have roughly $30,000 a year in essential expenses, and that's not counting our mortgage. This is also going to depend on the total properties we'll have in several different locations in the US or outside the US. Your essential expenses are the expenses you can't live without. And even without a mortgage, you would still have to pay your property insurance, taxes, and HOA if you live in a HOA community for whatever reason. You need utilities to keep your house running and groceries to keep your stomachs full, right? You would probably need transportation to drive from point A to point B. And also don't forget about your health insurance premiums, car insurance, life insurance, and other necessities to keep you safe from anything unexpected. Let's say we only have our stock market portfolio and it's down by 30% from $2.8 million to $2 million, and that would suck pretty bad, right? With a 4% withdrawal rate, that's from $100,000 a year to $80,000 a year. Not knowing if the stock market will continue to go down, we would probably change our withdrawal rate to 3% or lower, so we only withdraw $60,000 a year. If we absolutely have to retire by age 45, instead of fat fire, we would probably settle for a traditional fire. And if our portfolio drops by 50% in 1 year, and that's probably the worst case scenario, then we will hold off on our retirement until the market starts going back up. This is why we're constantly working on diversifying our income sources so that when the market becomes volatile, we will be able to rely on real estate, dividends, and maybe pensions. By the way, you can get our free fire resources by visiting firesidechat.com/contact. You can also check out the Fireside Chat shop, and I have all of my stuff on my bookshelf at firesidechat.com/shopping. So I've been buying the dip, and I meant it. And I personally like to hold 50% index funds and 50% individual stocks. The index fund I've been consistently buying is VT-SAX, which is the Vanguard Total Stock Market Index Fund. And I'll pull up the screenshot of my buy orders here. And back on April 8th, I bought $3,000 worth of shares in VT-SAX. I bought another $3,000 on April 22nd, and that's the date when the Dow dropped more than 900 points and NASDAQ dropped 4%. On April 26th, I bought more VT-SAX at $3,000 and another $3,000 on April 29th, May 5th, May 9th, May 11th, and May 18th. So far, I purchased $24,000 in total in VT-SAX, and I've been buying especially when the market crashes 3 or 4% in a day. On April 22nd, I bought one share of Google at $2,400. It dropped from $2,600 a share to almost $2,400 in a matter of days. I bought another share of Google on April 27th for $2,283, another share on May 9th for $2,250, and then another share on May 24th at $2,119 after Snapchat actually reported terrible earnings. I purchased 4 shares and a total of $9,058.78 just in the Google stock alone with a cost basis of $2,264. I'll continue to buy if the stock price continues to drop below $2,100, $2,000, or even $1,800. I'm going to buy as many shares as I can with the cash I have. So why am I buying Google? Well, I'm also buying other stocks, but just not in this portfolio. I'm loading up the shares on Google because it's so undervalued right now with a PE ratio of 19. This company is consistently growing by 15% annually. They make most of their money from advertisers who sell ads on YouTube and Google Search, right? They also make money from YouTube TV, Google Maps, Google Cloud, and so many other services. They made over $257 billion in revenue for 2021, which was a 41% increase from the year prior. They have almost $21 billion in cash and cash equivalent and $12 billion in long-term debt. If I had to choose between Apple, Microsoft, Google, or Meta, I would choose Google as the stock that has the most upside. And the market cap is around $1.38 trillion right now. And I can see it going back to $2 trillion in the next year or two. Okay, so don't forget, you pinky promised me that you won't buy it just because I said it, right? If you want me to do a full breakdown of the Google stock, let me know in the comment section down below. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.